Hello, I'm Matt Collins, Deputy Head of Longevity at SCOR. I'm delighted to talk with you today about the longevity risk transfer and how SCOR's solution can help manage your risk. We believe the US market in particular has huge opportunities for longevity transfer, and here's why. Historically, employers have provided longevity protection for their workforce through pension plans with defined benefits. The employer was responsible for putting more money into the plan if people lived longer. They effectively covered the longevity risk. This meant longevity risk was effectively spread across the whole economy. In recent years, a growing number of US employer-funded pension plans are transferring risk to the insurance sector to improve security for their employees and remove the risk of higher contributions. This pension risk transfer, or PRT, market is a huge success story for our industry. But it does mean that the longevity risk, which was once spread across the wider US economy, is now headed for the US life insurance sector. There is an increasing focus on the economic capital impact of taking so much longevity risk. Typical longevity stress might be as high as 6 to 8% of the value of the portfolio. For insurers where longevity growth outpaces other lines of business, this can quickly become material. Now, let me give you a quick overview of longevity risk and how it differs from asset risk. Together, these two are the key risks to be managed when providing a lifetime income in retirement. Asset risk is the key one many insurers focus on. Techniques like asset liability management can have a huge impact on the risk profile, helping to reduce the risk. After ALM, asset risk can still be volatile, especially over 1 or 5 year time horizons. However, it doesn't increase significantly over longer periods of time. Longevity risk, on the other hand, has a low volatility at first. However, because losses made in early years increase the likelihood of future losses, risk distribution for longevity expands almost like a trumpet as time goes on. True longevity risk can only really be measured over the lifetime of the obligation. These differences make it really difficult to provide meaningful comparisons of longevity and asset risk, and both are considered together for economic reserving purposes. However, it's important to look at overall longevity exposure and compare it to other risks on the balance sheet to decide whether retaining all the risk is sustainable. So, how can you manage the longevity risk and separate it out from asset risk? Longevity swaps are a very effective solution in that regard. They're used extensively in the UK PRT market for just this purpose. Now, word of warning, even though it's called a swap, this is actually a reinsurance agreement. In a simplified manner, here's how it works. Firstly, there's not a single upfront payment of premium. Instead, the cedent agrees to pay the reinsurer a series of payments based on the expected monthly payment that will be made. In return, the reinsurer pays the cedent a floating leg, or the actual monthly payments that are made to pensioners or annuitants. This structure is supported by collateral, which is the present value of the difference between the fixed leg and the floating leg. Longevity risk transfer won't necessarily be right for every client and every transaction, but we do see a few key usage cases. For very large deals, where the exposure to a particular pricing basis causes concern. For those taking longevity risk in an alternative jurisdiction where it can be capital inefficient. And for those who are becoming increasingly heavy in longevity risk. The practice of monitoring and understanding the costs of transfer are key to sustainability of that business. Thank you, and we look forward to speaking with you soon.